afternoon. Happy Friday, March 24th. Mark Milam here, your mortgage professional with Highland Mortgage. Let's get right to it. Another volatile week in the mortgage interest rate environment, but I will tell you, trending in the right direction. So compared to where we started the week, now we're finishing up easily a quarter point better across most note rates. Some note rates as much as 0.375% better than how we started the week. That's excellent, welcome news for potential home buyers in terms of improved affordability in the wake of still reduced inventory, which is causing more pressure on home prices to continue to stay elevated. So these lower rates are going to go to help loosen up the wallet a little bit for potential home purchasers. Let me show you what I'm talking about. If you look back over the past 5 days, you can see a pretty good amount of green on the board. That's exactly what we need. Some volatility there to start the week. We saw a little bit of volatility, and then this is Wednesday when the Fed announced that they had increased the federal funds rate by 0.25%. As happens more often than you might expect, mortgage interest rates actually improved on the day when the Fed announced an increase to the Fed funds rate. That's because the Fed funds rate is not a mortgage rate. It's an overnight lending rate to banks and financial institutions. It's probably the shortest term instrument you can get out there. Mortgage rates are 30-year instruments. They're long-term instruments, and they move much more in concert with the 10-year Treasury, which is a much longer-term look at where we're headed. And if you look at the 10-year, especially compared to shorter-term maturity instruments, the 10-year is much lower. We have an inverted yield curve, which can be a predictor of recession. But ultimately, we saw improvement on Wednesday on a day when you might otherwise think interest rates would be worsening thanks to actions by the Fed. These little thin lines are important to pay attention to because they show the trading range of each individual day. And you can just see a lot of volatility back and forth. I have alerts set up on my phone to notify me when the market improves or deteriorates more than a certain percentage. And my phone has just been going off all week long with 7, 8, 9, 10 alerts per day, letting me know that the market is bouncing back and forth. And that's a lot in reaction to what's happening with inflation, but mainly in reaction to what's happening across the international banking system. We all know what's happening here in the States. We know about Credit Suisse last week. We're getting news about Deutsche Bank today. Just a lot of uncertainty and fear around liquidity and solvency across the banking system, especially for these banks that have been affected by a higher rated stress test. So ultimately, that'll be interesting to play out, and it's really taken front and center in terms of what's affecting mortgage interest rates today, much more so than inflation. It'll be interesting to see if that continues in the weeks to come. Another interesting occurrence that happened this past week was the dot plot by the Fed members in terms of how they voted for the Fed funds rate and where they think we are headed in the years to come with the Fed funds rate. Let me flip the screen around and I'll show you the dot plot. So this is directly from the members of the Fed, and you can see, let me try to blow this up a little bit. We can see here, up here is 2023. This is how the members of the Federal Reserve think the Fed funds rate will finish out the year. Right now, we are at 5% on the Fed funds rate, and most of the voting members are showing that we're going to remain right around that 5, maybe 5.1%. But it's important to note there's 7 votes here at higher, more elevated levels than the 5 to 5.125% that we're seeing. Only one below that. But take a look at 2024. We're seeing most members thinking we're going to be down closer to that 4% range. That means presumably we would see one percentage point worth of cuts between 2023 and the end of 2024. Look at 2025, all the way down to 3, and then longer term even lower. That just tells you what the 10-year bond is telling you, which is long term, most people, including the Fed, think rates are coming down. Short term, going to remain elevated until we get some really positive news on inflation. Speaking of that, really positive news on inflation, all eyes on next week's economic calendar. We can see we start off the week with the Federal Housing Finance Agency Home Price Index, the Case-Shiller Home Price Index. We've got consumer confidence on Tuesday as well. We get into GDP revisions on Thursday. Jobless claims, always important on Thursday, but Friday's your big day. Friday is where we get the personal consumption expenditure. That's the Fed's favorite measure of inflation, not the most widely regarded, but it's the Fed's favorite measure. The core and the overall personal consumption expenditure, that will go a long way to telling us how the Fed feels about inflation. Are we tracking consensus estimates, continuing to decline, or maybe are we beating consensus estimates with inflation coming down? If we are, hang on to your hats. We could see much lower interest rates, and that would be welcome news as we move here into the spring buying market, helping out affordability for potential home buyers. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.